This feels like the final integration, everything coming together. Income tax, GST, stamp duty, fiscal policies. Honestly, this is where I want full clarity because now it's not about one topic, it's about how everything connects in valuation.
Exactly. This is the complete fiscal framework of real estate valuation. A professional valuer must not see these as separate chapters, but as interconnected layers affecting cost, income, risk, and value. Let us unfold this systematically.
Double slash.
This feels like the final integration, everything coming together. Income tax, GST, stamp duty, fiscal policies. Honestly, this is where I want full clarity.
Because now it's not about one topic, it's about how everything connects in valuation.
Exactly. This is the complete fiscal framework of real estate valuation. A professional valuer must not see these as separate chapters, but as interconnected layers affecting cost, income, risk, and value. Let us unfold this systematically.
Double slash. Let's start with income tax. How does it directly affect valuation?
Income tax affects valuation mainly through income and capital gains. Rental income taxed under house property. Annual value higher of actual fair municipal, 30% standard deduction, interest deduction.
So this directly affects NOI?
Yes, lower net income, lower valuation.
Capital gains.
When property is sold, statutory short-term gains taxed as per slab, long-term capital gains typically 20% with indexation.
So investor considers post-tax returns?
Exactly, that affects investment decisions and pricing.
TDS and compliance.
Buyer deducts 1% TDS above 50 lakhs, rent above 50,000 per month, TDS applicable.
So cash flow is impacted?
Yes, and compliance affects transaction smoothness.
Depreciation and housing benefits.
Depreciation allowed for business properties. Housing loan benefits reduce effective cost.
So tax incentives increase demand?
Correct.
Now GST. How does it change valuation?
GST affects construction cost and pricing. Under construction, GST applicable. Ready to move, no GST.
So same property, different tax depending on stage?
Yes, that creates price differentials.
Works contracts.
GST applies on construction services and contracts affecting project cost, developer margins.
ITC and RCM.
Input tax credit reduces tax burden, reverse charge mechanism shifts liability.
So tax structure affects feasibility?
Exactly.
Now transaction and holding costs.
Yes, 2 levels.
1. Stamp duty and registration.
Paid at purchase, based on circle rate or market value, increases total acquisition cost.
2. Property tax and municipal levies.
Recurring cost reduces NOI, affects income-based valuation.
So one-time cost affects entry, recurring cost affects income.
Perfect understanding.
Now the broader policies. How do they connect?
These influence the market environment.
FEMA.
Regulates foreign investment, impacts demand and liquidity.
Wealth tax or estate duty.
Influenced past ownership patterns.
Fiscal incentives.
Subsidies, tax benefits, improve project viability.
Government spending.
Infrastructure boosts value, economic health affects demand.
So macro factors influence micro valuation?
Exactly.
Now if I connect everything. Income tax affects net income. GST affects project cost and sale price. Stamp duty affects acquisition cost. Property tax affects NOI. Policies affect demand and feasibility.
Excellent integration. Now one more step deeper.
Final professional insight.
A valuer must always think in 4 financial layers. 1. Acquisition cost layer, stamp duty registration. 2. Construction cost layer, GST works contracts. 3. Income layer, rental income after tax, property tax impact. 4. Exit layer, capital gains tax. And above all these, macro policies influence the entire system.
So valuation is not just about estimating price, it's about understanding the entire financial life cycle of a property.
Correct. A true valuer must think like investor, tax planner, legal analyst, economist.
Now I understand. Real estate valuation is actually a complete financial ecosystem analysis.